In this video, we are going to figure out the price, the present value of a forward contract on a non-dividend paying stock. All right, so a forward contract is a contract to buy or sell an asset at some point in the future, and the forward price is the price that makes this contract fair. So if we have a forward contract where we agree to buy or sell something at the forward price, then it is going to have zero present value. Now, we want to value a forward contract with an arbitrary strike. So this could be a new contract where someone comes to us, if we're a dealer, and says, hey, we'd like to buy a stock for $112 or whatever it is at some point in the future. Or it could be an existing contract. So maybe someone entered it into it some time ago and they want a closeout price or that sort of thing. Okay, first we need to talk about some market structure so we have some sense of what's going on. We're going to have two kinds of market participants. We're going to have dealers. Dealers make prices, they make markets, they make the prices to buy and sell an asset. The bid is the price at which the dealer will buy, the offer or ask is the price at which the dealer will sell, and the bid is below the offer. And dealers make money from the spread between these prices, and generally they don't take directional views on the asset price. We then have clients of those dealers, and clients take the prices, so they're market takers. They take the prices to buy and sell an asset from a dealer, and clients generally lose a little bit of money every time they trade. They pay a little bit too much when they buy, and they receive a little, not quite enough when they sell, and they're generally taking directional views on the market. Classic market making is that dealers understand the market such that if a client buys from them at the ask, then they immediately go and buy from someone else at the bid and they make the bid-ask spread. Or if the client sells to them at the bid, they immediately go and sell to someone else at the ask and they make the bid-ask spread. They take some risk in this because if they can't execute fast enough, that second trade, the market can move against them. What I'm really trying to say here is that perspective matters. When thinking about prices, we have to think about whose perspective we're taking. And given that dealers make the prices and their clients take the prices, we should work from the dealer's perspective when trying to determine the price. All right, so we're going to look at a forward contract on a non-dividend paying stock. First, some notation. K is going to be the delivery price, that's known as the strike. T is the maturity of the contract. F is the fair forward price, and R is the risk-free interest rate. Now we're not assuming that K equals F. One little aside here, which definitely gets confusing with forward contracts, is we're used to seeing bid-ask prices with positive numbers. So 100.10 at 101.20. The bid is 100.10, the ask is 101.20. From the dealer perspective, if the client decides to buy whatever this thing is, we receive 101.2. And if the client decides to sell to us, we're going to pay 100.1. We can have negative prices. Negative 101.2, negative 100.1. If the client wants to buy from us, we're going to pay 100.1. And if the client decides to sell to us, we're going to receive 101.2. So a negative prices just changes the, right? We're receiving negative 100.1, which means we're paying it and that sort of thing. Changes the signs. This doesn't matter, and this can certainly show up in forward contract pricing. Okay, let's take the perspective of the dealer. We want to determine our market for a forward contract with strike K and maturity T. We want to find the bid and ask upfront payments that one of the parties must pay to trade the contract. So we want to find first the payment ask. So the client's going to approach us to buy the asset from us at time T for K, the strike. We want to find that upfront payment, and as the dealer, a positive upfront payment means the client pays us, and a negative upfront payment means that we pay the client. So we're going to agree the following transactions. We agree to sell the stock forward at time T for K. We receive that payment ask up front. We borrow S minus payment ask at the risk-free rate. So again, payment ask, if we assume it's positive right now, we have S dollars now. We buy the stock for S. We wait, we deliver the stock into the forward contract and receive K. We repay our borrowing, S minus payment ask, E to the RT. Okay, everything's gone. There's nothing left in our portfolio. And we always end up with K minus S, K minus the quantity S minus payment ask, E to the RT. For the strategy to be profitable, we need K to be bigger than S minus payment ask, E to the RT. We rearrange this and we see payment ask has to be bigger than or equal to S E to the RT minus K, E to the minus RT. And of course, if we set it equal, then we always end up with nothing in the future, and the present value must be 0. Now, notice in that formula, and I've written it in a particular way, that SE to the RT is showing up. SE to the RT for a non-dividend paying stock is the forward price. Okay, payment bid, same thing. Imagine a client approaches us to buy the asset from us at T for K, the strike. As a dealer, a positive payment bid means we pay the client, and a negative payment bid means the client pays us. We do the following transactions. We agree to buy the stock forward at time T for K. We pay payment bid to the client. We borrow the stock. We sell the stock and receive S, and we invest S minus payment bid at the risk-free rate. At maturity, we redeem the investment, S minus payment bid grown at the risk-free rate. We pay K and receive the stock, and we take the stock and return it to the lender of the stock at the beginning. At maturity, we have nothing left, and we always end up with S minus payment bid, the quantity, E to the RT, minus K. For this strategy to be profitable, we need K to be less than S minus payment bid, E to the RT, or payment bid is less than or equal to the quantity, S E to the RT, minus K, E to the minus RT. And if we set payment bid equal to that quantity, we always end up with nothing in the future, and the present value must be 0. Given that either strategy has 0 present value, if we set the upfront payment to be S E to the RT minus K, the quantity E to the minus RT, this must be the present value of the forward contract. Typically, and again, this we can derive in a slightly different way, but almost the same, we set up our formulation to be the present value of a forward contract is F minus K, E to the minus RT. Now, I'm going to do one of these examples. What happens if we set payment ask to be too small? Well, we can't follow our trading strategy, because if we do, we'll guarantee a loss. It's worth trying that, but you can see we guarantee a loss. We've got to follow classic market making. But other dealers and clients who understand the trading strategies, that hedging strategy, will trade against us and make money. We'll find ourselves always buying or always selling. And if we find ourselves in that situation, we're going to have to adjust our prices. Now, to summarize, the present value of being long a forward contract is F minus K, E to the minus RT. Short a forward contract, K minus F, E to the minus RT. Or the present value of a forward contract to buy N units, where N is positive if we're buying and negative if we're selling, is N times F minus K, E to the minus RT. So those are the formulas we need to know. So let's do an example. Non-dividend paying stock is trading at 110. Risk-free interest rates are 4%. A client approaches us, we're going to be the dealer, and asks for a two-way bid and ask price for a 6-month forward contract on 1,000 shares with strike 115. So they're specifying the strike. We want to make 50 cents per share up front, irrespective of what the client trades. What's our market? So first we calculate the forward price, SE to the RT. This is straightforward. So F equals 110, the stock price, E to the risk-free rate times maturity. So that's E to the 0.04 times a half, 112.22. The fair present value of this forward contract, the one the client wants to trade, is N, number of shares, times F minus K, E to the minus RT. Plug in our numbers, 1,000 times 112.22, sorry, there's a typo there, minus 115, E to the minus 0.04 times 0.5. negative $2,722.85. We want to make 50 cents per share or $500 regardless of whether the client goes long or short. So if we go long, we're agreeing to buy the shares for more than the forward price. We should get paid. Thus, the price of the forward contract is negative. We make our market negative $3,222.85 at negative $2,222.85. Again, you have to think for a second, but that bid is less than the ask. So let's do an example, see what happens. If the client decides to go long, if the client's going to go long, we're going to pay them $2,222.85 up front. We're going to immediately borrow 1,000 times 110, 110 is the share price, plus $2,222.85, $112,222.85. We take the $2,222.85 of this to pay the client, and with the remaining $110,000, we buy 1,000 shares, and then we wait. In 6 months, we deliver the 1,000 shares that we owned, and we're paid $115 per share, or $115,000. We repay our borrowing, $112,222.85, e to the RT, which is $114,489.90. We've just made $510.10. The present value of our profits is $500, which is what we wanted to make up front. So you can see with this example, even if the strike on the forward contract is not the forward price, we can still come up with the payments, the bid and ask payments for this specific forward contract, which makes it profitable to us as a dealer. And of course, if the client had done the opposite thing, had decided to sell us the shares in the future, we could have followed the second trading strategy and made the $500 up front, just like this example.